One group, they ended up investing in a park in New York State. The very first day that they took ownership, they raised the lot rents $300 a month, just immediately, without doing anything to the property. So anyways, the tenants ended up organizing against this, and they got Time magazine to come out and do this article about how private equity investors are predatory and ruining people's lives and all this stuff. There's tenants that showed up at this person's house harassing, and there was just all this stuff. And he ended up, unfortunately passing away. But his daughter called back, and the daughter was like, "Hey, is your offer from last year still on the table? Because we'll just take it."
Hi, everybody. Jose Luis Morales here. Welcome back to the Residual Real Estate Agent Show. Today, we've got a very special guest. His name is Ben Kahle. He is based out of Virginia. Ben is a fund manager that specializes in investing in mobile home parks and self-storage facilities. The current holdings are approximately $200 million worth of real estate. And today he's going to be talking to us about investing in mobile home parks, what to look for, how to know if you've got a deal or not, and maybe some tips and tricks as to how to make sure that you get the best deals on mobile home parks. So welcome to the show, Ben. How are you?
Oh, I'm doing great. Thanks so much for having me on.
Of course, man. So first question, who is Ben Kahle, and how did you get started in investing in mobile home parks and self-storage?
Sure. Yeah. So, my name is Ben. I'm 28 years old. I live here in Virginia. I moved here about 10 years ago for college. I always grew up knowing I wanted to do something in real estate. So my grandfather do real estate, never really knew how to get involved. I ended up getting my real estate license when I was in college, and ended up meeting my now partner, Paul Moore. This was about 8 years ago, and one thing led to another. We just kind of kept our heads down and stayed focused, and we decided to get into the commercial real estate space. I think the residential space is amazing, tons of opportunity there. I think commercial just kind of suited me better.
I agree, man. And what made you get into mobile home parks specifically? And the reason I asked that is I've been in residential, I've done some multi-unit family, but I've always been curious about mobile home parks just because of the different opportunities that we'll talk about, but I've never really known what to do or how to find deals or anything. So what made you, like, how did you come about the mobile home park space?
Yeah, great question. Yeah, and I think a lot of your listeners are obviously familiar with single family rentals or duplexes or apartments. But yeah, mobile home parks, it's a little bit different, a little bit more unusual. So my partner, he has a background in multifamily, and multifamily, it's great, recession resistant, there's scale, they're everywhere, the cash flow, tax benefits, all that stuff. A couple of years ago, maybe around 2016, 2017, my partner, he's in his 50s. He's seen some cycles, and he kind of saw where multifamily was, just where cap rates were. Cap rates just, being compressed, meaning prices are very high. There's so much attention on multifamily. And most of multifamily apartments, over 50 units, according to the U.S. Multifamily Housing Council, I think like 90% are professionally owned and operated in the U.S. So that means there's a company that, has a background in owning and operating and marketing and managing. And a lot of times, a lot of value has been wrung out of a lot of multifamily deals. It's just harder to find them. Mobile home parks, on the other hand, the vast majority of mobile home parks are owned by a mom and pop who might have one or two at most properties. So there's about 40,000 mobile home parks in the United States. And there's estimates, it's hard to get an exact number, but people estimate that 75% or more of the mobile home parks in the United States are owned by mom and pop. So what does that mean? Well, mom and pops, they've owned it for 20 years, 30 years. They don't have debt on it anymore. They haven't raised the rents in years. They don't have good staffing. They don't have good marketing. There's typically a lot of deferred maintenance. They haven't collected rents from every tenant. They just don't have to. They don't have the desire, the time, the energy, the resources to do those things. And so the strategy with mobile home parks and what kind of attracted us to it was we can go in and invest in a park that has intrinsic value, meaning we can go in and day one, there's rents that can be raised to a reasonable level. We're not going in and jacking the rents. You can clean up the park. You can get rid of the non-paying tenants. You can get better marketing. You can fill the vacant lots, which is actually probably the way that you can get the most value. It's probably the biggest value add lever you can do with mobile home parks is filling vacant lots. So anyways, those demographics, along with the fact that there's just a massive affordable housing shortage in America, kind of led us to look very closely at mobile home parks.
Yeah. What is attractive to me, and correct me if I'm wrong, for mobile home parks, unlike multifamily, you don't have to fix toilets. You don't have to fix. So can you talk about some of the benefits in that as opposed to maybe multifamily?
Sure. Yeah. So there's two different types of parks out there. You'll have parks that have the tenant owned homes, and those are the more appealing. And then sometimes you'll have parks where the park owns the homes and rents the homes out. The most attractive from a lot of different perspectives is to buy the parks where the tenants own their own homes and they just pay a lot rent, which could be anywhere from $200 a month to maybe $600 a month in more expensive parts of the country. And yeah, you can run a 100 plus unit or 100 plus lot mobile home park where the tenants own the homes with maybe one person on site, because you don't have to worry about the maintenance. You're basically just keeping up with the grounds and the common areas. Sometimes there's a pool, sometimes there's a community center, stuff like that. So there is ways for those of you who are interested in, really diving deep into mobile home parks. There are ways where you can transition and sell off the park owned homes. Let's say you buy a park, it has 100 units or 100 lots. You can slowly over time sell off those homes and transition it to tenant owned homes. It's a longer process and there's more risk involved with that, but it's certainly possible.
So you can actually work it. You can basically go back to the type where you don't have the maintenance to deal with, at least
exactly.
That's
exactly.
awesome.
And so, yeah, I mean, like you mentioned with the maintenance and stuff, I mean, the expense ratios for mobile home parks where the tenants own the homes, I mean, it's much, much different than a multifamily building, much lower, just naturally.
You mind me asking what those look like, just out of curiosity? I know for mobile home parks, expense ratios are generally 40, 50%, just depending on the year that it's built and obviously the location as well too. You mind me asking what an expense ratio typically is for a mobile home park?
Yeah, I mean, so multifamily, like you mentioned, maybe around 50%, 40%. I think it's not uncommon to see 30%, 35%. It depends on the part of the country, and it depends on, just kind of how much common area or grounds there are to maintain. But I don't think that's unrealistic to see. It's in the 30s.
So let's go to the beginning. Like, if I was looking for a mobile home park, how would I know what markets to invest in? Are all markets created equal? And is there a certain type of number of units that I would be looking for? Or is it just all parks are created equal?
Yeah, no, that's a great question. So I'll start talking about multifamily. So multifamily, if you're going to be buying a 100 plus unit place, you're probably not going to want to go to a town of 30,000 people.
Yeah.
right? I mean, a town of 30,000 might only have one or two buildings of that size.
Hmm.
So I think it matters that the market matters a lot more for multifamily compared to mobile home parks. And this is just from our experience. Like, we're invested in mobile home park in Gillette, Wyoming.
Hmm.
Okay, it's the middle of nowhere, Wyoming. It's a town of, I believe, 40,000 or so. And we're invested in other smaller markets like that. And I just think it's totally different. I don't want to say like, and I do think this, like, invest where you know the best.
Hmm.
So if you, let's say you want to go out and say, I'm going to build my own multi or mobile home park portfolio, it's going to be tough for you to have a competitive advantage in random markets across the country right away, unless you can bring on people who do have those competitive advantages. So I think it's okay to be somewhat agnostic when it comes to mobile home park markets.
Hmm.
In starting off just with what you understand and what you know the best. I don't want to say that the market doesn't matter at all. Certainly income, certainly population growth, net domestic migration, all those kind of metrics, they matter. How diverse is the employment
Hmm.
in that market? Like, if it's a town where there's maybe, one factory that employs X thousand people, and you look at your mobile home park and you see that a certain percentage of those tenants are employed by this, that's just the level of risk there. But I think you can thrive in mobile home park investing even in smaller tertiary markets. And especially now, I think you almost, if you're just starting off, I think you almost have to go to the smaller tertiary markets because there's so much equity from big players flowing into mobile home parks in the larger markets. Blackstone has been investing in mobile home parks. TPG, another quite large private equity group, they've been investing in mobile home parks. There's a number of other larger groups like them. And it's crazy, but it's not uncommon to see a purchase cap rate for a mobile home park in a nicer area in a bigger city at like a 3.5 or 4 cap, like going in, which is crazy, I think.
And what about a tertiary market? Is that typically what you see in those type of markets as well too, or is the cap rate higher in
The
those?
Yeah, the purchase cap rates I think are definitely higher in the smaller tertiary markets. Um, and there's a caveat to purchase cap rates. And
Yeah.
for those of you who understand cap rates, um, the lower the cap rate, the more expensive, the
The
more
project.
multiple you're paying for the NOI. The higher the cap rate, the generally the less expensive. And I think the caveat with with purchase cap rates going in is how much value can be added,
Hmm.
because you could buy a mobile home park at let's say the going in cap rate on the trailing 12-month financials is 3.5, but the rents are $300 under market, and they have 20 vacant lots, and they aren't doing any marketing. Okay, well, that cap rate almost becomes slightly
Irrelevant.
irrelevant
Yeah.
because you can go in and start raising rent. So that's just a little, because I think a lot of times people throw around these purchase cap numbers, but it doesn't take into account that full picture of what's the value that can be added to that place.
Yeah, I bought a 25 unit apartment and I bought it at a 4.5 cap, but the rents were $800 below market
Jeez.
rent on
Yeah,
it. So it's like people were like, well, why would I buy something at a 4.5 cap? Well, they missed the value add opportunity of how far behind the rents have gone
totally.
relative to where the marketplace is. So, are there any rules of thumbs when underwriting like mobile home parks, or how do you know if you've got a good deal or not? I think it probably
Hmm.
goes back to the conversation that we just had in
Hmm.
regards to looking for that.
I mean, I think it, again for our world, it all starts with the operator
Hmm.
and like the people that are going to be running the park and managing the park. So that's kind of separate. But if you're just looking at it like at a really high level,
Hmm.
what makes a good mobile home park? I do think that can become subjective depending on your skill set and your background. But most people like to see public utilities. A lot of a lot of groups will get nervous about private utilities just because of the costs associated with that, and you have to maintain that. Um, I think it's great. Like the ideal situation for mobile home parks today is you can acquire it directly from the owner, directly from the mom and pop owner. So publicly marketed stuff, even in smaller markets, is not really where you want to be in most cases, just because there has been a lot of attention going to mobile home parks from investors in the past couple of years. So yeah, getting it directly from the owner, I think some deferred maintenance is a good sign. I think yeah, like rents being below market, you want to look for that. You want to understand how like what is the market rent, how high can we really push this, and not in this way of oh we want to just squeeze every last little dollar. Like I think you should always be looking at from the perspective of how can we make this a better place to live for these
Hmm.
tenants, because some of them are on fixed incomes. Some of them, this is they own the home, and they don't want to move, they don't want to leave, and so we don't. I think that's important to consider as well. um, there's a lot more nuance there, but I think that's the high level stuff.
Are are there restrictions as to how much you can increase the rent? I know in California, I looked
Hmm.
into a couple of mobile home parks, and they
Yeah.
were regulated by HUD, I believe, or some sort
Yeah.
of governmental agency, and there was limits on one of them. There was a limit of 3%, that's how much you
Yeah.
can increase it, which doesn't
Yeah.
even keep up with inflation now. Is that
Yeah.
nationwide, or are there certain markets where there are no
Yeah.
restrictions?
Yeah. Yeah. Great question. So that is not nationwide. So I'll give an example. We just last month invested in a portfolio of mobile home parks in New
Mhm.
York State. And we've like from what we do, like we've been kind of nervous about New York State and
Yeah.
California and some of these other states that do have rent control. And we hear the noise just around landlord tenant laws and all that. So we were a little bit concerned about that. New York State, just as of, and this is not including New York City because New York City is a totally different animal, but the rest of New York, most of these parks are in upstate New York. They just enacted rent control in 2018, I believe, and it is 3% a year. But you can add another 3% a year for if you can show the reason why you need to increase that much to the New York Housing Authority. So let's say you have a larger or a bigger property tax assessment than what you anticipated. Um, let's say you made a bunch of improvements to the property. Um, let's say that you can you might be able to prove something with inflation or labor costs. And I think what's also important in New York State is that rent control only applies to legacy tenants.
Mhm.
So there, and that's like a nuance that I don't know how every state that has rent control works. But let's say you buy a park and there's is a 100 lot park, and there's 20 vacant lots. So all those 20 lots that you can fill up, you can start the rent at whatever level you want. But the legacy tenants, yeah, the rent control is still in effect there. But in our experience, and from what we've seen, it's not something to be super afraid of. And
Mhm.
what's interesting, the operator we invested with, he actually, or their group, they weren't raising their rents 3% a year before rent control. They They just didn't need to for where they were at. And now they do. They're raising the rents more now after rent control, and the tenants just are like, oh yeah, this is how it is. It's 3% a year no matter what. It's one of those kind of unintended consequences of,
Yeah.
just kind of government intervention. But does that answer your question? I know there's a lot of nuances to rent control, and it depends on like
Yeah.
the state and the locality.
Yeah, no, I kind of figured that in some states it wasn't like that. And I agree with you that sometimes rent control makes landlords want to increase the rent just so that they don't feel like they're falling behind. What is the in a mobile home park where the owner does not own the mobile homes? What are
Mm-hmm.
they responsible for? Meaning, let's say the
Mm-hmm.
tenants own the mobile home. What
Mm-hmm.
things are they responsible for?
Yeah, it's pretty simple. So it would be the roads,
Uh huh.
and let's say it's in a northern state and it snows, clearing the roads, making sure those are good. The leasing office, if there's a pool, the pool, if there's like kind of like a rec center type situation, which some have, maintaining that. But it's that's pretty much it. I mean, maybe enforcing the rules,
Hmm.
dealing with tenant issues, making sure trash is going where it needs to go.
Hmm.
But yeah, I mean it's pretty minimal.
Yeah. So I know that you mentioned that, and this kind of goes for most real estate. In order to find good deals, sometimes you got to go direct to owner. Sometimes you can
Hmm.
find deals publicly listed. I know for multifamily, it's Reonomy. I've heard
Hmm.
that Reonomy is one of the platforms. Are there specific platforms specific for mobile home parks, or is that something that would be very similar to multifamily?
Yeah, I don't know of any like that. I mean, I think the multifamily world, there's just a lot more attention there, and so there's there's just more dollars flowing into the data.
Multifamily. Yeah.
For mobile home parks, you can get lists of owners
Hmm.
from
Title
there's
reps.
yeah, like there's different sources that you kind of have to do in a more backwards way. I'll give an example of like what a good acquisition strategy looks like, I think, for mobile home parks. So one of the groups we invest with in their deals, they have a team of 6 full-time employees, US
Mhm.
based, in their office in Las Vegas. And all they do 5 days a week, 8 hours a day, they make 150 to 200 calls each
Wow.
every day to owners of self storage and mobile home parks. And they've been doing this for 9 years, if you can believe that. And they call the same owners every quarter. And even if that person's not ready to sell right then, they
Stay in
this
touch
is
with them.
this has happened, like where they had one owner they were calling on, and the owner kept saying no, 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 not ready, not ready. He was an older gentleman, and he ended up, and unfortunately passing away. But his daughter called back. This was probably 2 or 3 years after they first started calling him, and the daughter was like, "Hey, is your offer from last year still on the table? Because we'll just take it." And that type of thing is just, it just happens when
Wow.
you have that type of a system and a strategy, and you're like putting so much into that, and they
Mhm.
pay those acquisition people very well when they put a deal together and they actually end up closing on it. But I think it's hard. I don't want to say impossible, but it's hard for the solo guys and gals to go out and do something like that. I think you could narrow it down
Mhm.
to, your county or your city, and you could do it yourself and put together stuff, and you could knock on doors, and get in touch with these owners. But you would be surprised at what these owners are willing to give up their property for, just because they want it done quickly. They don't want to work. This is crazy to me. They don't want to work through a
A
big
broker.
hotshot broker. Like, they don't want that whole experience of all these people coming in and out and having to provide all this data, and they don't have great books. They don't have
Yeah.
great records. And they just, so if you can come in with cash and build a relationship with that seller and build the trust and just be a good person, like you can get deals that the big groups never see. And that's where the value, a ton of the value is created, is from the acquisition strategy, I think.
Can I ask, what's the best deal you've ever seen on a mobile home park? Just out of
Yeah.
curiosity.
Yeah. Yeah. It's pretty cool. So my partner and I remember we flew to Louisville in January 2020 to
Hmm.
look at this park. It's a 315 lot park.
Hmm.
And we ended up investing in it. It's purchased for 7.1 million.
Hmm.
The owner had passed away, and the wife was managing it from like 5 states away, and there was a lot of issues going on. There's a lot of intrinsic value, in our opinion. We end up getting an unsolicited offer 2 weeks later, 2 weeks after closing, for 9 million. So purchase for 7.1, unsolicited offer 9, and we were like, no way, it'll be worth 13 to 14 million in 4 or 5 years. There was like 50 vacant lots. The water, the park was paying for the water for everyone, so we could submeter the water and then just raise the rents slowly over time. So those are the three big main value adds. So we were like, yeah, whatever, we'll hold off. And so that was closed in February 2020. I think sometime around August, September 2020, another group came in with another unsolicited offer for like 13 million. And
Wow.
like, mind you, the value add strategy was not complete at all.
Hmm.
And so anyways, end up working with that group and end up selling the park for 15 million in December 2020. So after 10 months, we had more than tripled the equity,
Wow.
because we purchased it for like half debt, half equity. And it's great, right? I mean, it's a great win, but and this is kind of this is coming to some of our investing philosophy is, it's a problem, because you got to pay taxes, you got to redeploy the capital. You can't just go out and find another deal like that, immediately. And so we're always in this tension of like, should we monetize, or do we want to just hold very long term forever and just refinance every 3, 4, 5 years, get the money back tax free, and we keep our cash flow going. So it's always this tension for that, but that's definitely the best deal by far that we've seen.
That's crazy. What are some of the mistakes that you've seen, maybe not yourself, but like other operators do? Or what are some of the problems that these mobile home parks typically experience? Is it like crime? Is it like, yeah.
Yeah, yeah. I mean, I think mistakes. We our model. So we vet out a bunch of different operators. We know almost everyone in the space. And we've only invested with a handful of people. And so we've seen a lot of different ways of doing things. And one group, they ended up investing. We did not invest with them. They ended up investing in a park in New York State. And the very first day that they took ownership, they raised the lot rents $300 a month, just immediately, without doing anything to the property, without doing a darn thing. And in fairness, it was because the lot rents were so low before compared to the market, but still. So anyways, the tenants ended up organizing against this, and they got Time magazine to come out, big media, and do this article about how private equity investors are predatory and ruining people's lives and all this stuff. And this group got blasted out there, and there was tenants that showed up at this person's house, uh, harassing, and there was just all this stuff. And so I think that's an issue. I think going into a park and just immediately raising the rents without any communication to the tenants, without any attempt to build a relationship with the tenants, I think that's an issue. And there's a number, if you Google like mobile home park, John Oliver, that HBO guy, he did this whole segment on how mobile home park private equity people are ruining people's lives, and the New York Times did articles about it. And there's a number of different things going on out there that, and unfortunately, when there's a few bad actors, it can give a bad name to the whole kind of industry. And so that's, I think, what, in my opinion, not that I'm some crazy expert, but I think if you raise the rents, you need to be communicating with the tenants and have the on-site staff, communicate, hey, like this is our plan, how we're going to make it a better place to live. This is our plan for how we're going to, fix X, Y, Z. On the flip side, one of the groups we invested in a park in Iowa, kind of the middle of nowhere, Iowa. And it was private utilities. And the tenants paid for their own water. And there was some leaks in the pipes, and it was causing these tenants' water bills to be super high, or way higher than they should have been. And operator goes in, raises the rents. Nothing crazy. I want to say, $25. And the tenants actually were so happy that there was a new ownership that a couple of them like baked a cake and brought it to the manager and was like, thank you for doing this. And that of course doesn't always happen, but I think that's like the opposite sort of experience, where you raise the rents and you have a relationship with tenants and you make it a better place to live.
That's so awesome. It's so true, because I read a book. It was by Brian Murray. It was called "Crushing It in Commercial Real Estate." And in that book, that was my very first commercial book. He talked about sometimes before increasing the rents, show good faith in showing that you're fixing some of the items. He talked about fixing some of the common areas, fixing some of the exterior of the building, making it look nicer, showing good faith that you've got a plan to make it a better place to live. And he talked about how that would help them see the fact that it's making a better place to live, but it will also help the bottom line, as opposed to just increasing it on day one. So how does somebody go about like filling vacant lots? Like, let's say that we have 20 vacant lots. What's the best strategy there?
Yeah. So really, you need to have a flow of either new or used mobile homes to be brought in. And that's been a bit of an issue with supply chain in the past couple of years through COVID. So Clayton Homes is the largest and probably most well-known mobile home park or mobile home manufacturer. It's actually owned wholly by Berkshire Hathaway and Warren Buffett, which is interesting. But basically, you need to have a flow of those homes, and you need to be able to market them and sell them off, whether it's like a kind of like a lease to own type strategy, or if you're just going to get them set up with a lender. And there's of course only certain lenders that will lend on mobile homes. So you need to have that kind of relationship set up and be able to coordinate that. So it's not uncommon to put the homes on Craigslist or Facebook Marketplace, and simple things like that are free and attract tenants that way. But yeah, I think it's the most lucrative strategy by far for mobile home park value adds.
Yeah. And then what about depreciation? Like, I know I hear this. I read a book on mobile home parks. I've never done any mobile home parks, but it's obviously an area that I'm interested in. They said that depreciation is higher on mobile home parks than multi-unit properties. And when I read that, I was like, how could that be? Is that true? And
Yes.
if it's true, if you have any idea as to why.
Yeah, it's crazy. And it doesn't seem like it would make any sense at all. Like that's what I thought, because it's the tenants own the homes. Like, what is there even to depreciate? It's just like land and utilities and, maybe a couple buildings. I think the most, at least recent example of this kind of in real life for us is one of our funds invested in 2 mobile home parks, and in December of 2021, there was a cost segregation study completed before taxes, and we got our K1, and the depreciation box 2 net rental real estate loss was like 300% of our equity. It's crazy.
That's crazy.
And yeah, I mean, if you're a qualified real estate professional, IRS status, then you can use those losses against your active income. Let's say you have you qualify as a real estate professional. I'm sure you do. I do. My wife has a W-2 job. We can use those losses from our investments in our funds to offset her W-2 income, which is crazy. And it's I talked to a tax professional. I'm not a CPA, or I'm not giving any kind of financial advice, but why? I don't fully understand it, to be quite honest, other than there's a portion that can be deemed goodwill, and the IRS, and it's permissible to just do it. I mean, I would say, I use the internet every day. I don't understand all the inner workings of the internet, but I can still enjoy its benefits. And I think about the depreciation kind of like that. I don't understand every last aspect of it. I just know that it helps my taxes. And I know that self-storage and in mobile homes and multifamily and industrial, they all have their own kind of different schedules of depreciation, kind of what's normal. But from what we've seen, mobile home parks are by far the best for depreciation.
Yeah. And it's funny because when I read that, I couldn't believe it. But then everybody I talked to says the same thing. How do you finance mobile home parks? Like, I know for multi-family, there's obviously, I think Freddie and Fannie doing a large portion of the financing. What is it like? What does it look like for mobile home parks? Is it mainly like private financing? Is it are Freddie and Fannie involved in that as well too?
Yeah. So if you can believe it, yeah, Fannie and Freddie have a mandate actually to deploy a certain amount of lending dollars into affordable housing, and so they're doing that primarily through mobile home parks, which is crazy. I mean, so before interest rates were going up, you could get, this was 2 years ago and 3 years ago, you could get a 10-year Fannie loan at like 2.9 fixed, with like 4 years, 5 years of interest only, with options for supplemental refinances to pull out equity along the way. I mean, it's so good. I mean, so there's that. It has to be a pretty high quality park, and it has to be less than 30%, or sorry, it has to be at least 75% tenant-owned homes to get a Fannie or Freddie loan on a mobile home park. So if that's not the case, or if the park is lower quality and has some issues, you can go to a number of smaller regional banks that understand this stuff, and they love it too. You'd be surprised how many smaller banks out there understand mobile home parks and will lend on them all day. And not as good terms, but still good.
Typical financing is probably like 10-year and then amortize over 25 or 30 years. I would
30.
imagine.
Yeah. I mean, if you're going to a bank, like a smaller bank, you'll probably see 5-year terms. It's probably more common, 30-year AM, and probably not interest only, maybe for like a year.
Mm.
And maybe, I mean, right now everything's kind of different, but a couple years ago, you could get maybe whereas a Fannie Freddie, you get like 2.9, you might get like 4.5 from a regional bank.
That's awesome.
Different now.
And then this is the last question that I wanted to ask you. I invested a lot of money into actively buying properties myself and
Hmm.
then managing them myself. But recently, I seen huge value in investing with syndications and funds. If somebody
Hmm.
wanted more information on your fund, how does that work, and how can they get in touch with you as well too?
Sure. Yeah. Sure. Yeah. I mean, I'd say that, passive investing in non-liquid real estate, it's not for everyone. There's a
Mm,
lot of considerations there, in terms of your money is not going to be able to be just pulled out at any second. And
mm,
there's tax considerations. So investors in our funds, we have to file in a couple different states beyond our own state. And we get K1s. And there's other considerations, but I mean, if it's intriguing to you, our website is wellingscapital.com, WELLINGS capital.com, and you can just kind of learn more about us there. Um, I think education is where it all starts. Like the more you know, the more exposure you have to different syndicators and different groups out there, the better you'll be able to see, what fee structures are actually investor friendly, and you'll be able to see just what's out there. There's a wide variety now. And over the past 10 years, there's been so many newer groups popping up. I think, one of our main criteria is we want to only work with operators who've been doing it at least 10 years and ideally through a recession. There really hasn't been a recession. Everyone thought it was going to be COVID. There really hasn't been a big downturn since 2008. And a lot of these newer syndicators, they've never experienced what it was like my partner did to, go through a crazy time like 2008, 9, 10. And it's my opinion that you could be a so-so operator, like a mediocre one, and still have really great returns over the past 10 years because of the market and
mm.
just where everything is going. So that's what I would say. Get educated, get online, look at the forums. There's Bigger Pockets is a great resource. There's a number of other groups like that. Yeah, and check out our website if you want to.
Sounds great, man. Well, I wanted to say thank you for being on the show. Obviously, I felt that it was a lot of great information. For all of our viewers out there, if you've enjoyed this episode, this was episode number 112. We had Ben Kahle. He's out of Virginia, real estate fund manager, and owns approximately $200 million worth of real estate, or manages about $200 million worth of real estate. So I wanted to say thank you again, Ben, and we appreciate you taking the time to kind of share all this information with our viewers.
Oh, love it. Thank you so much, Jose, for having me on. It was great.
Thank you, brother.